Swayam Prabha. Digital India. Educated India.
Okay, good morning. So, in the previous class we talked about the Markowitz portfolio theory, which is the basic foundation stone of the concept of the portfolio management process. And then the next thing is, whenever we do the practical investment in the market, some of the basic issues always we should look into how the market is and what are those different characteristics or the different factors who basically play the role in our investment process or in our portfolio construction process. So, these are the different questions basically comes to the mind of the investor, and when the investor feels that where to invest and where not to invest, and whether we should take a single asset or we should invest in a combination of the different assets, what we talk about the or we define it as portfolio. So, in this context there are other theories have been developed to analyze all those factors which basically play the significant role in the portfolio management process. In this context, the first and foremost theory after the Markowitz portfolio theory basically we have, that is the capital market theory, and what exactly the capital market theory is and how this theory basically helps us to take the decision in the investment process in the market, that we will be discussing today. So, if you see what exactly the capital market theory is, capital market theory is nothing but it is basically an extension of the portfolio theory what already I told you, and the previous class we discussed about the Markowitz theory. So, capital market theory is the extension of that, and it basically develops a model. It basically specifies the function for pricing of all risky assets, because whenever we invest in the market we have the various assets to be invested, and where should we invest and where we should not invest, that basically is decided by the risk appetite of the investor, and the risk appetite of the investor varies from investor to investor, and therefore, the various investors basically decides the different assets to invest on the basis of their risk profile. And whenever we talk about the different assets of different type of risk profile, then how we can say that what kind of expected return or what kind of expected benefit we are going to get if we invest in that particular stock. So, that particular questions or that particular issues has been addressed by the capital market theory. So, basically capital market theory develops a model, it specifies a function which will help us to calculate the expected return from the various assets. In this context, I hope you must aware about or you must heard about this model. We define that capital asset pricing model. So, it is the foundation stone, or we can say that founding theory of capital market. So, here if you see that capital asset pricing model will allow you to determine the required rate of return for any risky asset. So, capital market theory basically starts with the capital asset pricing model, and in this capital asset pricing model what we do, the basic objective of the capital asset pricing model is to calculate the required rate of return or the expected rate of return on the basis of the risk profile of that particular asset. So, what we can say, the investor uses the capital asset pricing model to calculate how much expected return he is going to draw if he will invest in a particular asset or in a particular stock. Therefore, in this context what we can say, it helps us, the capital asset pricing model helps us to take any decision in the market whether to invest in that particular stock on the basis of the risk profile or the risk appetite of the investor. Before going to the different mechanism or different concepts related to these different logics involved in this particular model, let us see that before developing this model we have certain assumptions for the people, basically the survey who has advocated the capital asset pricing model. To develop this capital asset pricing model, survey has taken certain assumptions. What are those assumptions? And the first assumption is all the investors are Marquis efficient investor who want to target points on the efficient frontier. If you recall the previous class, what we have seen that Marquis has talked about the efficient frontier. In the efficient frontier, we have the different portfolios which give you the best alternative return with a given amount of the risk, or best alternative or minimization of the risk with a given amount of the return. So, basically when this either of these two criteria will be fulfilled, we define that portfolio is defined as the efficient portfolio. And here what basically this Marquis assumption or Marquis theory was talking about, and with this particular assumption or particular explanation what Marquis has talked about, the capital asset pricing model basically always feels or always assumes that all the investors are on the efficient frontier only. That means, everybody wants to fulfill one of these conditions of the efficient portfolio. Then second one is investors can borrow or lend any amount of the money at a risk free rate of return. We will discuss extensively what basically exactly this risk free return is. Then all investors have homogeneous expectations, that is they estimate identical probability distribution of future rates of return. That means, the expectation of all the investors are almost homogeneous in nature, and they are expecting that from the distribution point of view, or if you see the risk return profile point of view, all the stocks or all the investors who want to invest in this particular stocks or particular assets, their probability distribution, the expected return what they are going to draw from this particular assets, these are homogeneous. The probability distribution functions of the expected return will be homogeneous. That means, there is no such kind of divergence between the expectation level of the investor for a particular stock. So, everybody assumes that the probability distribution is same for all types of stock what they are going to invest. Then all investors have the same one period time horizon, such as 1 month, 6 months or 1 year. So, what here this is a very serious assumption what the capital asset pricing model takes, because the investors profile, if you see, investor always invest in the market on the basis of his or her requirement. So, if you assume that all the investors time horizon or the requirement of the return of a particular time period is same for all the people, then it is very difficult, or we can say it is one of the serious assumption what the capital asset pricing model takes, because on the basis of the requirement the investors time horizon for investment changes. Somebody wanted, so maybe some investor wants the money after 6 months, maybe some investor wants after 1 year, and some investor wants the realization of the money after 5 years, depending upon their requirements, depending upon their position, financial position in the market. But here what the capital asset pricing model assumes, it assumes that all the investors time horizon is almost equal. So, therefore, we can say that this is one of the very major assumptions, but it is a very serious flaw in this particular theory. In the beginning, what we can say, all investments are infinitely divisible, which means that it is possible to buy or sell fractional shares of any asset or the portfolio. It is very clear, basically what we can say, that any kind of any number of shares can be bought from the portfolio, or the fractional shares of asset or portfolio can be bought or can be invested in a particular market. There are no taxes or transaction costs involved in buying and selling assets. What generally we have seen that already we know in the practical world, there are huge amount of transaction cost we face whenever we practically do investment in the market. We have the different fees, we have the different type of cost which are involved in this particular investment process. But here what the capital asset pricing model assumes, there is no such kind of cost or there is no such transaction cost which are involved in this investment process. So, therefore, what we can say, the investor only feels that how much risk he is going to face. So, there is no such kind of transaction cost or quotation cost involved in this case. So, which is basically a theoretical concept in nature, it is very difficult to, or it is not possible to raise the money, or it is not possible to invest in a particular asset, or it is not possible to buy or sell a particular asset without any kind of adjustment cost. But this is the assumption from the beginning the capital asset pricing model takes. Then there is no inflation or any change in interest rates, or inflation is fully anticipated, which is again is a very serious assumption what the capital asset pricing model takes. If they said that there is no inflation, the price level will almost stagnant, or we can say it is almost stable. There is no chance of increasing or decreasing inflation, or we can say there is no chance of increasing decreasing the interest rates, which is basically a serious assumption what the capital asset pricing model takes. Because what we have seen that day to day life, the interest rate every day fluctuates, and depending upon the demand supply situation, there is no control of the regulatory authority, and there is no control of the monetary authority or the government to reduce. Maybe they have certain measures, they have certain policies through which they can reduce this, but it is not possible to make this inflation stagnant for a particular period of time. But here what the capital asset pricing model assumes that the inflation rate is almost stable, or there is no change in inflation rate, and as well as even if it is changing, then it is fully anticipated. What do you mean by this? That means the investor can realize that whether this particular inflation will increase or decrease, and if it will increase and decrease, then how much it will increase and how much it will decrease. So, that is the basic assumption or basic things what the investors were trying to explain whenever they want to use this capital asset pricing model theory. And another variable which is very important variable from all investor perspective and as well as common man's perspective, that is interest rate. And if you observe that interest rate also is a market driven instruments, the interest rate is determined on the basis of the demand for and supply of certain variables. But here what we have seen that the capital asset pricing model again assumes that interest rate is also not going to be changed, and again that is why what we can say that in our strategy or in our investment process, what we have observed from the basic theoretical background, that always we assume that the interest rates cannot be stable, and the most dangerous or most we can say that unpredictable way of predicting this unpredictable way of making the strategy for investment in the market is to predict the interest rate, because interest rate cannot be predicted fully. Even if it can be predicted, so then the direction also sometimes not go with the expectation of the people. If this investors expectation will not go with this market sentiments or the demand supply position of certain variables who generally determines the interest rates, then it is very difficult to say that whether the interest rate will be stable in a particular period or not. So, that is also a very important assumption, but is a very serious assumption what the Sarpe and other people have taken whenever they derived this capital asset pricing model theory. Then finally, what we have seen that the capital markets are in equilibrium. This means that we begin with all investment properly priced and in line with their risk levels. Again you see that it is very difficult to say that always the capital market is in equilibrium and always all the assets are being priced fairly, because of maybe there are certain peripheral variables which play the significant role, but those variables have not been taken care by the people who has advocated the capital asset pricing model. Therefore, again, but here to explain this capital asset pricing model, and which is the foundation theory or the we can say the basic theory where the investment theory starts with or the capital market theory starts with. In this context what you can say, so you have to take that assumption to derive that particular thing. So, therefore, what we can say, there are certain assumptions which is viable, there are certain assumptions which are not viable in the practical sense in today's world, but to explain this capital asset pricing model theory, these are the assumptions what the Pharma and other people have taken whenever they derived this concept of capital market theory, or we can say capital asset pricing model in a particular investment context. Then if you see that how this particular thing works, or how the what is the explanation of the capital asset pricing model. Already I told that the capital asset pricing model is nothing but it is basically a model which explains or which gives or which helps us to derive the required rate of return from a particular asset or a particular portfolio. So, that is why what we have seen that it is basically nothing but there is a trade off this particular model is trying to make between expected return and the risk. So, whenever we have taken into account the risk free rate of return, what basically we have seen that the existence of a risk free asset resulted in deriving capital market line that became the relevant frontier of the investor. So, what we have seen here that what we are trying to say that in the previous case you must have observed that we have risk and return, and whenever in our portfolio we are taking a risk free asset, basically here the return and risk involved in the various assets what we are trying to take to make our portfolio. But here if you observe that once we take that there is a risk free rate of return involved in this, then obviously without any risk we are getting some return, which is the basic characteristics of the risk free rate of return. So, that is why what generally we say that whenever we saw this trade off between the risk and expected return, the expected return and risk it basically gives you a line like this, which we can say the capital market line, and which is the basically the frontier of that particular investor in that period. So, what we can see here that once we have seen that there is a risk free return in your portfolio and there are other risky assets in the portfolio. So, in this context your line basically looks like this. An asset's covariance with the market portfolio is the relevant risk measure. Basically what it talks about that if you want to make a relationship between asset, one particular asset either in individual stock or anything else with the market portfolio. Already we have seen that the market portfolio is a concept where the maximum, it is basically optimal portfolio, where your utility curve or utility will be curve will be tangent to the efficient frontier. That means, this is the best possible combination of the different assets. So, what we have seen here that the risk which is affecting the expected return of the stock, that is basically the covariance between the asset and the market portfolio in that case. That is why this can be used to determine an appropriate expected return on a risky asset, and which is defined as the capital asset pricing model, which is defined as the capital asset pricing model. Capital asset pricing model basically tries to answer the question like what should be the expected return of a particular stock or particular risky asset by assuming the portfolio consists of another risk free asset, the portfolio has risk free asset and the portfolio is a combination of risk free asset with other risky assets. So, CAPM already I told you that it indicates what should be the expected or required rate of return on the risky asset. This also helps us to value an asset by providing an appropriate discount rate to use the dividend valuation models, which will help in further, or we must be talking, we have already talked about anything in the equity valuation models. You can compare the estimated rates of return to the required rate of return to know which particular asset is overvalued or undervalued, that we will see in the further slide in the detailed manner. Then we are coming back to certain things, what basically the risk free asset is. Already I have shown you that this part in the y axis, this is basically your x axis and this is your y axis. So, what here we have seen this part, particularly this vertical part, this is basically the risk free rate. So, in this case already I told you that
the risk free rate means from the name itself you can predict the particular asset which gives you the return without any risk. So, if the particular asset which gives any return without any risk, that particular asset is defined as the risk free asset. So, that is why this asset has 0 standard deviation and it has 0 correlation with other risky assets, because there is no relationship of this asset with other kind of risky asset, because whether this particular asset will have any impact of any return on other assets. It is basically whether we should invest in a risk free asset or we should invest in the risky asset, there is no such kind of linkage, there is no such kind of relationship between these two. It will always lie on the vertical axis of the portfolio graph, already what I have shown it to you. What generally we can see it here, that if you observe certain things, that the risk free asset whatever we have, and always what we have seen that this always on the vertical axis. If you take the real example, it is basically the treasury bills in India, treasury bills or government securities, any of the other government securities. Why do we call it? Because these kind of assets gives you the assured return, without any risk. These are the asset which gives you the assured return without any risk. That is why what we call it, these are the assets which is defined as the risk free assets. Already I told you that this is the, if you talk about the risk free asset, then risk free asset is nothing but it is the covariance between two sets of return, that is the already you know that the covariance it is nothing but the RI minus expected RI and divided into the RJ minus expected RJ divided by n, and because the returns for the risk free asset are certain, then the standard deviation of the risk free asset will be 0. Therefore, the actual return or the return is equal to the expected return, and there is no difference, between expected return and the realized return or the actual return whatever we have. Therefore, the covariance of the risk free asset with any risky asset or portfolio will always equal to 0. Therefore, the covariance of the risk free, correct, remember the covariance of the risk free asset with any risky asset or portfolio is always equal to 0, and similarly the correlation between any risky asset and the risk free asset would be 0, that already we have explained. Then if you combine what we have seen, that whenever we invest in a particular portfolio, if the portfolio combination is basically the combination of the different assets, and already if you see that we have taken a portfolio which is a combination of the risk free asset with other risky assets, then how we can calculate the return? The return is basically calculated in this way. Already you know that the expected return is the weightage what we have given. For example, 50% we have invested in the risk free asset and 50% we have invested in risky asset. So, here what you can see that the expected return of the portfolio is equal to 50% into your RFR, how much return you are getting, plus 1 minus W, what percentage we have invested already here, that is your 50%. So, that is W 1 minus RF is also 50% multiplied by the expected return of the particular stock. So, then what you can calculate? You can calculate the total expected return of that particular portfolio in that situation, and this is a linear relationship always existing between these two. But if you see this combining risk free asset with a risky portfolio, already what we have seen in the previous class, whenever we talk about the expected return of assets and as well as the expected return of the portfolio, and also the risk of the asset and the risk of the portfolio. So, here what we have seen certain things that if you see that already we know that the expected variance of the portfolio is nothing but it is the W 1 square, the variance of the first asset, and W 2 square the variance of the second asset, plus 2 W 1 W 2 the covariance of these two, but basically it is standard deviation of half, standard deviation of 2 and R 1, because the covariance of 1 and 2 is nothing but it is the correlation between between these two and R 2 R 1 2 and standard deviation of 1 into standard deviation of 2. But here if you already what we have seen that one asset is your risk free asset. So, if one asset is your risk free asset, then obviously what will happen, then this part will be 0, because this variance will be 0, then this part will be 0, then it will be W 2 square, then the variance of the return of the second asset plus the here also this term also will be equal to 0. It is because this term will be 0. If this term will be 0, then automatically this will be 0, then the expected variance of this particular portfolio will be W 2 square and the variance of the risky asset what you are taking. So, that is why this is the thing what we are trying to say. Since we know that the variance of the risk free asset is 0 and the correlation between the risk free asset and any risky asset also 0, we can adjust this formula in this way, and finally, we can arrive here the W 2 square into the variance of the second asset. So, what we have seen that whenever we have seen that this formula is expected portfolio is nothing but this 1 minus W R F, which is your W 2, W is equal to 1 minus W R F, what we have named is as W 2. So, this was basically what we have finally arrived. The expected variance of the portfolio is equal to 1 minus W R F into the square into the variance of this particular asset. Then obviously, the standard deviation will be the SD will be the square root of this W R F square into variance of this particular asset. So, finally, it will be 1 minus W R F into the standard deviation of this asset. Therefore, the standard deviation of a portfolio that combines the risk free asset with risky asset is the linear combination or the linear proportion of the standard deviation of the risky asset portfolio. Therefore, the standard deviation of a portfolio that combines the risk free asset with risky assets is the linear proportion of the standard deviation of the risky asset portfolio. Therefore, if you combine this risky asset with another risk free asset, then it is basically the risk what we are going to face in terms of the risky asset, that basically tells the risk level of that particular portfolio than the other assets. So, since both the expected return and the standard deviation of return for such a portfolio are the linear combinations, a graph of possible portfolio returns and the risks looks like a straight line between the two assets. Already I have shown it to you. So, this is basically what we have seen, that this is your expected return of the portfolio, this is your this is the expected risk of the portfolio, this is your expected return of the portfolio, this part will be your risk free rate, and if you see these are the combination of the different this is your A, B, M, these are the different efficient portfolios of whatever we have, and that is why this is your capital market line, which is talking about the inclusion of the risk free rate in this particular portfolio, which is gives you the linear combination of risk free asset and the other assets. Then what we have seen that if you have the different portfolio, this portfolio gives you the best or the optimum portfolio. It is because that this particular capital market line or this line, basically it is derived from this line it is efficient portfolio. From here it derived this line, and if you observe here, this is here, and instead of this we have risk free asset with other assets. That is why this is the linear combination of this, one risk free asset, one risky asset. This is another linear combination like that, then this is the best portfolio whatever we have, and because of this linear combination the trade off line is a straight line in this case. But another observations, if you see that what is the risk return possibilities with the leverage, what does it mean? It basically to attain a higher expected return than is available at point M in exchange for accepting higher risk. Because in the previous slide what we have seen that the M is basically which is defined as the optimal portfolio or optimum portfolio or the market portfolio, and here what we have seen that this particular M, if you want to get higher return than that, then what you have to do, either you invest along the efficient frontier beyond point M such as point D. In the previous slides whatever we have seen, and this is your point D, either you invest here or you can if you observe here we have this is your capital market line, and this is your efficient frontier, and this is your D what we have seen, and this is your B and this is your A. So, if you want to get your expected risk, and this is your expected return of the portfolio, this is your risk free rate. So, what we have seen, if you want to get the more return than this M, then what we have to do? We have to do only either you invest in the D which is beyond this M, and in this case what you have to do, you have to taking more risk, or add leverage to the portfolio by borrowing money at the risk free rate and investing in the risky portfolio at point M. So, what generally other options you have? You borrow the money at a risk free rate without any risk and invest it at M, which gives you the more return than the risk free rate. So, if the M basically it is a combination of the risk free rate and as well as the other assets, you borrow the money at a risk free rate, invest it at M, then what will happen that for example, your risk free rate is 6%, because of high risk your market maybe give you this 10% return. So, you borrow at a 6% rate, invest it in a market portfolio, get a 10% return, then 6% even if you pay him, then another 4% extra return what you can get it. So, that is why what you can call it that this is the concept of adding the leverage in the risk return possibilities. So, that is why add the leverage to the portfolio by borrowing money at a risk free rate and investing in a risky portfolio at the point M. So, this is basically the lending and borrowing situation what we just now talked about. So, here you can lend it at this rate and borrow it in another rate, and sometimes what you can see that you will find a different combinations of risk free rate of return with other risky assets which is on the efficient frontier line. Then how generally the portfolio choice is made on the basis of the risk free or the capital asset pricing model. The more conservative the investor, the more is placed in risk free lending and the less borrowing. It is also already reflected in the practical also it is possible. If the investor is so conservative, they always put place in the risk free lending and the less borrowing. The more aggressive the investor, the less is placed in risk free lending and the more borrowing. Less is placed in the risk free lending and more the borrowing, and more aggressive investors should use leverage to invest more in portfolio M. Just now what we talked about here, they always get the money, lend the money at a risk free rate and try to invest in the M, which is the market portfolio or the optimal portfolio, which gives you the best maximum alternative return than the other portfolios whatever we have. That is why all the aggressive investor who always wants to beat the market at any moment, they always try to extract that benefit, because they borrow the money at a risk free rate and invest in a market portfolio, and they get higher return than the risk free rate, and finally, they always try to enhance or try to maximize their return in that particular situation. Already I talked about little bit on market portfolio, but in enhance if you see or in a extensive manner, if you want to know what exactly the market portfolio is, it is the most important factor which helps to use the capital asset pricing model and how it will be helpful and how the capital asset pricing model is tested or measured, that we will see further. But here if you observe minutely what exactly the market portfolio is, that here the all investors hold the same optimal portfolio of the risky assets, and the optimal portfolio is the highest point of the tangency between the capital market line and the efficient frontier, and the portfolio of all risky assets is the optimal risk portfolio, which is defined as the market portfolio. That is why the market portfolio is basically a risky portfolio, and it is the combination of the different risky assets in the market. And if you have this particular portfolio, you want to construct this, then this should be the tangential point between the capital asset, the capital market line and the efficient frontier. And capital market line is nothing but it shows the risk return trade off of the portfolio, that various portfolios on the basis of their expected risk and the expected return. It is the different combination of this, and finally, you can arrive the market portfolio where this line will be tangent to the efficient frontier. What are those characteristics of the market portfolio? The characteristics of the market portfolio is all the risky assets must be in the portfolio in the market portfolio case. So, it is completely diversified. What does it mean? Already we talked a large in the previous class about the diversification. It is basically the market portfolio tries to minimize the unsystematic risk to the highest level, because there should not be any unsystematic risk in the market portfolio case. So, that is why we say that it includes only the systematic risk, which is a market risk, because we cannot avoid the systematic risk, which is basically affecting or which is the risk which is basically involved in all the assets in the market in a particular time. So, all securities included in proportion to their market value. It contains worldwide asset, basically either it is a financial assets, real assets or any other assets whatever we have. That is why the market portfolio is the best optimum portfolio, where the return maximization can take place. Return maximization can take place with a given amount of the risk level. Then if you see exactly how the capital market line look like, already told you the capital market line is nothing but it shows the relationship between or the trade-off between the expected return and risk of the different portfolios, which are basically the efficient portfolios. So, the line from RF to L is the capital market line. Already what we have seen here, this is the line, and X is the risk premium, which is nothing but the return from the market minus the RF, and Y is equal to your risk, and slope is equal to your X by Y, which basically talks about the expected return from the market minus RF divided by the standard deviation of the M. Then Y intercept is the RF. This is basically the RF, already what we have seen. Then if you see that if you want to convert in the equational form, then how this equation will look like for a capital market line. The slope of the CML or capital market line is the market price of the risk for efficient portfolios or the equilibrium price of risk in the market. The slope of, remember, the slope of the capital market line is the market price of the risk of the efficient portfolios, or it is the equilibrium price of risk in the market. So, the relationship between the risk and expected return of the portfolio, what basically already you can observe here, this is basically your expected return from the portfolio is basically nothing but the RF plus already we have seen that expected RM minus R f divided by the standard deviation m into the standard deviation of the p, or we can say this is the R f into R f plus beta into R m minus R f. This is basically nothing but the systematic risk. Systematic risk in the market. Then there is the different theorems has been derived in this capital market line case. What are those theorems are basically what we call it the separation theorem, the capital market line and the separation theorem. It talks about so many important implications, it gives lot of important insights to the investor. It basically the CML leads all investor to invest in the market portfolio. The individual investors should differ in position on the CML depending upon their risk preferences or risk appetite, and how an investor gets into a point on the CML is based on his financing decisions on the basis of their risk level. A risk averse investor will lend part of the portfolio at the risk free rate and invest the remainder in the market portfolio. Investors preferring more risk might borrow funds at the risk free rate and invest everything in the market portfolio, that already we have seen. The decision of both investors is to invest in portfolio M along the CML, because this is the best optimal portfolio whatever we have, which is the tangential point between the efficient frontier and the capital market line. The decision to borrow or to lend, basically to obtain a point on the CML, is a separate decision based on the risk preferences. So, CML and the separation theorem basically gives importance to risk appetite of the investor or the risk profile of the investor, how the investor is preferring, how the investor is deciding to the different assets on the capital asset pricing model or the capital market line case. Therefore, the Tobin, basically the famous economist, refers to the separation of the investment decision from the financing decision, which is defined as the separation theorem, because the financing decision of the investor basically gives the risk level, how the investor wants to finance this investment, however the investor wants to invest the money, that basically measures the risk level of the particular investor depending upon the risk appetite, because the financing decision again depends upon the risk appetite of the investor. So, if the risk appetite of the investors are more, so accordingly they decide where to invest, where not to invest. That is why we call it the separation theorem. Then another concept which largely used in the portfolio literature, that is the security market line. Here if you observe one thing, that I have derived this model in this case. Here what we have seen in the capital market line case, the capital market line basically talks about the risk return trade off of the portfolio, efficient portfolios, but the security market line basically talks about the risk return trade off of the individual assets. It is basically the individual assets, and where to invest in these particular, these are the combination of the individual asset. This is your risk free rate, this is your SML. So, here how this SML is derived in this case, that the relevant risk measure for an individual risky asset is its covariance with the market portfolio, that already we know that how much risk is involved for a particular asset, that basically is measured by the covariance between the market portfolio and the individual risk. The return from the market portfolio should be consistent with its own risk, which is the covariance of the market with itself, that is already we know. So, that is why already what we have seen, that this is your SML, this is basically the risk level, this is your expected return from the individual assets. So, it talks about the SML. So, let this is your market portfolio here, and this is your market portfolio, then this is basic, it should be your RM, this should be your standard deviation of the M, whatever thing we were talking about. So, this basically talks about the SML line, And how this SML line is derived, here if you observe, the SML line is derived, already I told you the expected return is basically your risk free rate RF plus, already we have seen RM minus RF divided by the variance of M, the covariance IM. Okay. So, this is basically RF plus covariance IM. If you rearrange it, standard deviation variance of M into RM minus RF. So, this covariance IM standard deviation M, this basically nothing but the beta. So, therefore, it is equal to RF plus beta into RM minus RF. RM is equal to the market return, RF is equal to the risk free rate of return, beta is equal to your systematic risk, and RF is equal to, already we explained, that is the risk free rate of return. So, this is basically the derivation of the security market line. So, the expected return of a risky asset is basically determined by the risk free rate of return plus a risk premium for the individual asset. The risk premium is determined by the systematic risk of the asset, which is beta, and the prevailing market risk premium. In a larger way, we will explain it in the further sessions. So, in equilibrium, if you observe what generally we can see, all assets in the portfolios of assets should plot on the SML. Any security with an estimated return that plots above the SML is underpriced, and any security with an estimated return that plots below the SML is overpriced. That we can imply from this. A superior investor must derive value estimates for assets that are consistently superior to the consensus market evaluation to earn better risk adjusted rates of return than the average investor. If you ask you one question here, how this SML and CML are different? Why the SML and CML are different? We can make a statement here, basically CML is a special case of SML, special case of SML. Because why it is a special case of SML? Because here what we have seen, that the market portfolio what we are taking in the CML case, this is basically efficient portfolio, and whenever we calculate the efficient portfolio, already that means this particular portfolio what we are taking in the CML case, that is totally highly correlated with the market portfolio. So, if it is the highly correlated with the market portfolio, let us assume that it is totally resembles this market portfolio, then how this market portfolio work? It is basically your expected return is equal to your RM minus RF is equal to RF plus RM minus RF into covariance IM, the variance of the M. But here the covariance between the individual securities with market is nothing but it is the correlation between the market and the individual securities, and the standard deviation of the I and standard deviation individual securities and standard deviation of the market. But here if you observe, in case of the CML, if you assume that the correlation between the market and the individual security is almost close to 1, then what we can say, in this case what will happen, the it will be expected return will be equal to RF plus it is standard deviation I into standard deviation M divided by the variance of the M, because the this term will be equal to 1, then it into RM minus RF. But again what we have seen, this is again we can cancel it, then expected return is equal to RF plus standard deviation of I divided by the standard deviation M into RM minus RF in the case of CML. But in the case of the SML, basically this is the in the generalization of this particular equation. So, therefore, sometimes we call the capital asset pricing model, or we can the capital market line is a special case of the security market line. So, a superior investor must derive value estimates for asset that are consistently superior to the consensus market evaluation to earn better risk adjusted rates of return than the average investor. So, compare the required rate of return to the expected rate of return for a specific risky asset using the SML over a specific environment horizon to determine if it is an appropriate investment or not. So, that is the way generally this capital market theory helps us to our investment process. So, here if you see the certain things what generally we are trying to explain that capital market theory or the CML helps us to calculate the, this is your RF plus this helps us to know that how much return we require, to invest. This is your risk and this is your expected return. So, this is basically helps us to know how much expected return we need to invest certain securities. So, what it basically, what we have seen from the beginning, there are certain limitations of these assumptions whatever we have. Even if there are certain limitations whatever we have, still the capital asset pricing model holds, or capital asset pricing model talks about certain issues related to the investment, or it is very much required to use to calculate the expected return or required rate of return. How much required rate of return should this particular asset give, or how much return this particular asset can give to the investor, or how much expectation we should have on that particular investment to maximize the return. But the another question here is that there are certain variables which used in the capital asset pricing model to derive this expected return, and those variables whatever we use in the capital asset pricing model are determined by certain external factors. And if you talk about the certain external factors, it basically helps us, or it basically gives you the more dynamism, the more dynamic concept of the use of capital asset pricing model to derive the expected return for an particular risky asset. Therefore, what we can say, we should know more about the inputs or about the requirements of this particular use of the capital asset pricing model, and if you assume or if you relax certain assumptions whatever the capital asset pricing model takes, then what is going to happen in this model. That is basically the more enhanced objective of the investor to know that, because once we calculate the expected return of the particular asset, it basically talks about the cost of this particular asset, because we are taking certain risk, and once we certain risk, it is basically the opportunity cost what we talk about, the second best alternative whatever we have, we are foregoing that cost and we are investing in this particular asset. So, therefore, there are certain cost we are incurring for this, and there are this cost what we are incurring, the expected return from that particular asset should be more than that. That is the basic intuition, the basic assumption always investor takes. So, therefore, what is the basic objective of the investor is now, the basic objective of the investor is to know the factors which affect this equity return, or the factors which affect or which helps to formulate the capital asset pricing model, and how those factors can be determined. So, that we will see in the next class. Thank you.